We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side.
That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Lance Lewis. He's president of Lewis Capital and runs the gold and gold equity strategy and also the publisher of the dailymarketsummary.com. How are you today, Lance?
Good. How are you?
Excellent. Great to have you. So, Lance, you were a trader and a gold mining and technology analyst for David Tyson Associates. So could you tell us a bit more about your time there and some of your biggest lessons learned, please?
That was back when David Tyson Associates used to run the Prudent Bear Fund, and they also had the Safe Harbor Fund. They sold that back in 2008 to a Federated, I believe. I wasn't there at the time when they sold it, but I guess what I learned, that was my first Wall Street job, and it was funny because being a technology analyst back then, it was fairly easy to identify shorts. This was the year 2000. And the market had peaked in March, and after that, it was pretty easy to target. You could go look at XYZ company, and the semiconductor companies started spitting out warnings. But then you could go to they're going to be ordering less equipment. You could go and you short those names, and you could kind of move on down the line of the cycle. And it was fairly easy because there was a lot of retail involved on the long side. It's much What I learned was it was extremely easy back then on the short side. It's much, much harder now. Now it might get easy again at some point now that you've had a lot of retail come into the market, over the last 12 months. But it became extremely difficult after that to make any money on the short side. And that was the case up until, about 2008, I guess. And then, of course, it was that way again after 2008. Prudent Bear was a short fund, and so they were required, it was a mutual fund, so they were required to always be short also, just because people used them as a hedge. And so they would have varying degrees of being short, maybe 50% short, but basically they had a minimum that they always had to be. And of course, over time, markets go up. And over time, the way the math of short selling works, position, if you're short a stock at 10, goes against you at 50%, you've lost half your money. So even if it goes back down again, I'm sorry, I said that wrong. Stock goes up to 15, and then even if it goes back to 10 again, well, you're not back at par. You're still down because of the way the math works, because you're less short after it goes against you, and you've lost 50%. Mm-hmm. So basically, the lesson was a fund that is required to be short all the time is eventually going to go to zero. That's just the math of it. Now, that through management, you can vary the length of time it takes for it to go to zero, but it's eventually going to go to zero. Yeah. And there will be periods where you make, where it's going to have big upside performance. But there again, because markets generally go up over time, you're going to zero, unless, this is the one caveat, unless the market goes to zero one day. But you're still,
unless your timing is perfect, right? So, Lance, you've developed a gold sector market timing tool. So, can you tell us a bit more about what some of the inputs that go into that model and how you actually kind of switch back and forth on both sides of the trade at different times based on the data that the model is giving you?
Yeah. I believe gold's going higher over time, but to me, it's not a religion. It's another thing to trade out there. There's no boogeyman that's banging on it to the downside, and there's no magical force that's lifting it. So what the computer model that I built, basically it has DSI goes into it, the HCNSI goes into it, the DSI for silver goes into it, moving averages go into it, the GLD holdings, because it's the largest ETF, go into it, and those holdings relative to some moving averages, because I've found over time that based on where those holdings are relative to those moving averages, it tells you whether gold's in a bull phase or a bear phase. And the COT data goes in there as well, and then a couple other minor things that I just tossed in. But those are the primary weightings that go in, and I've back tested it, and I came up with basically three three tiers of buy signals, one being the strongest, three, the third being semi-strong, could just be a bounce, and then same on the sell side where, tier one sell, except in, some rare cases, like for example, I got several tier one sells in July and August. And the last time that happened was actually 2011, going into the blow off that's, into the high in September. So actually when the first tier one sell I saw, I thought, okay, well then this is going to turn over. And this, because also, I got a tier one sell back in March and in February too, before things broke in 2020. And, but then when it kept ignoring it and I kept getting them, when was the last time that happened? 2011. So it actually suggested a blow off is coming. And sure enough, we went on into early August and you had that blow off that basically occurred. And then once it ended, down we went. So, basically I've kind of learned, I just developed it, about 2 years ago. And the first year it was kind of a learning process to actually figure out how to use it. Because like I said, there's varying degrees of signals. And sometimes like with the one I had in the summer, it's not telling you to sell. It's telling you that something even more extreme is coming, to the upside. And I'm sure that can happen, on with the buy signal as well. If you keep getting buys and yet the price keeps going down, well, and actually that did happen in 2013. So it works both ways, but you kind of have to know how to use it.
So is this a tool that's basically obviously based on the technicals and technical indicators to take the fundamental noise and kind of give you some perspective from an unemotional point of view?
Correct. And then there have been times where I've literally, especially when I was first using it, I'd get a sell signal or a buy signal or whatever, and I wouldn't believe it, and I would ignore it. And I'll admit, when I got a sell signal in late February of 2020, after GDX had broken out to a new high and gold broke, looked like everything was getting ready to lift off. And of course, you go back and look, there are other commodities that were actually deteriorating then and kind of told you there were problems. But I got a sell signal then. I didn't believe it. On the day of the high, I got a sell, and it was a tier one sell, and I just flat out didn't believe it. I didn't do a thing, and that was a big mistake. But like I said, that was when I was kind of still learning how to use it. And then I ended up, I got a buy signal on the low. Now I did react to that one because everything else was in place as well. The Fed came in with both barrels or 3 barrels, 4 barrels, whatever you want to call it. And so it's like anything else. They're not magic beans. It's not a on off switch that it's always right. You still have to learn how to interpret it. But using it in conjunction with everything else you're looking at, I find it's a very useful tool.
So gold's behavior since the new year, like we've been kind of sitting in this $100-ish channel, kind of between 1850 and 1950. So what could contribute to us breaking out of this range?
I believe it's going to take more QE from the Fed, but as with all of these big moves to the upside in gold, you have to first get the downstroke before you get the upstroke. And it's my suspicion that you're going to see another one of these panics to the downside, probably in everything, including commodities, stocks, the whole bit, to actually make a low in gold. And at that point, the Fed will come in and increase QE, and then you're going to get another slingshot move like you did back in March. And the same process, if you think back to 2008, occurred as well, where you could see the mortgage crisis coming like a large snowball down the hill, and you knew what the Fed was going to do in response to it. They're going to take rates to zero and they're going to print money. But if you reacted too soon to that and went out and bought gold stocks, let's say in the summer of 2008, well, you were down 80% by the fall and going, what the hell? I was right, yet you were wrong because your timing was off. So I suspect we're in another one of those periods where timing is going to be very important, and everybody that's looking for inflation is probably going to be right, but they're going to be really wrong before they're right.
So why do you feel that the bounce back up from this 1825 level is just a bounce, and we might see a retest of those lows until after the FOMC?
Well, one of the main reasons, because my model never gave a buy on this recent low. Now it gave a tier 2 buy, back on the late November low. But a lot of times a tier 2 buy can just be, a bounce. Like, for example, I got tier 3 buys all, on the lows, every low that we had since August. And those were good for usually a week or a week and a half to the upside before, the rally failed and you went lower. Now the tier 2 buy, that rally lasted, into the first couple of days of the year, about a month. But, again, the tier 1 is really the slam dunk. I found it's never been wrong. And I haven't gotten that yet. And all the data is still much closer to a sell than it is a buy, even though I haven't gotten a sell. I never got a sell, which you wouldn't if you're still in a bear trend from August. You wouldn't get one. That's not how it works. And just, things I see, the mining equities themselves, the advanced decline line for the GDX made a new low for the move just last week, even though the indices are still above their November lows. The bullish percent for the GDX, which many people don't know, is actually just a composite index of how many stocks in the GDX are bullish, quote unquote, using point and figure charts. So if it's below 50%, less than half are bullish charts. It has nothing to do with sentiment, which I see that in print all the time, that bullish percent's low. That means everybody's bearish. It's got to go higher. That's not how it works. So right now you're below 50%. So basically it's telling you that less than 50% of the stocks in the GDX index are actually in bullish point and figure configurations, which is bearish. And that just occurred a couple weeks ago. You actually crossed the 50% mark, and you crossed the 50% mark on the upside back in March, April, when you took off out of the hole, which signaled above 50, as you would expect, more than 50% are bullish is a bull market typically. So there are a lot of things. The GLD holdings are below a key moving average that I watch, which is generally bearish. Just the way things trade. If you look at gold's basically kind of popped on some of these stimulus headlines, and then a couple days later it gives it all back. We've been moving since the Democrats won the Senate, which was at the time I thought, okay, because we were still moving higher at that point. That was the first couple of days of the new year. That would slingshot us higher, and we were headed even higher. And instead, if you remember what happened was it kind of, 10, 12 bucks the upside that night after the election. And then wham, hammer came down the next day for no reason. And everybody's kind of, and myself included, well, I don't know what that was. That's a little weird, but, give it some time. Let's see how this kind of, all sifts out. A few days later, unemployment report. Even before the report hit, gold broke $25 overnight for no reason. And then when the report hit, it was a disaster, which told you more stimulus is coming, a lot of it. And what did gold do? Fell another 50 bucks. So, something's wrong when the market doesn't react like you would expect it to. And it can a lot of times be much more telling than when the market does react like you would expect it to. I can remember in December of 2012, when the Fed came in with their second round of QE back then, QE2, I think, QE3, that's what people called it, because it was the second round on top of the one they had done in September. I remember that the day of the FOMC, gold had a nice rally, it had been moving up, and it actually went down on the news. And I remember thinking, that doesn't seem right. I didn't think much of it at the time, but then of course, as 2013 unfolded and the gold price steadily, headed lower, even though you had this massive monetary stimulus going on, there was a problem. Now, I'm not saying it's 2013 again, but in the short run, something's not right the way gold trades. And it just seems like this is another, you bounced up into all of these falling short-term moving averages in the GDX and the gold price itself. And it basically, in the rally, kind of stopped. I mean, we'll see what happens here over the next few days, but, it doesn't trade right to me.
Mm-hmm. So as you're talking about how, these markets that aren't reacting the way that we think they would, you recently posted a chart about Bitcoin breaking to the downside from a compression triangle. So do you have any thoughts as to what is causing one of the strongest inflation trades to turn over, as you put it, and why the rest could follow?
Nobody knows what moves Bitcoin day to day. I mean, it's just animal spirits that move the thing around. But I think it is highly responsive to liquidity. And if you talk to a Bitcoin bull, they'll tell you that's one of the reasons they own it. It's because they're bearish on the dollar, fiat currencies in general, and they're long Bitcoin. So when it starts to have problems, and I guess I should also mention that a lot of people think that Bitcoin is stealing from gold. And there may be some of that, I agree. But I guarantee you it's not going to work. Just as Bitcoin may be stealing from gold, it's not going to give to gold if it starts to correct. If Bitcoin starts to correct like it appears to be doing now, it suggests that there could be an overall liquidity issue in the market itself where you're getting ready to have a lot of things start to sell off. And gold has obviously been under pressure for 6 months.
Why are the gold miners and the dollar suggesting a major stock unwind could be coming?
Well, because the gold miners I've found are even more sensitive to liquidity than equities in general, and even commodities for that part, because there's a speculative component to gold stocks, relative to gold. So when they don't act well, it can many times be indicative of a coming problem in the broader market. If you think back to going back to 2008 again, that summer gold stocks basically started to collapse, and it preceded the market collapse that you got in the fall in the S&Ps. I mean, the market was moving lower at the time, but nothing like the crash that you got in the fall. And the gold stocks, the way the bottom kind of fell out of them, told you something's wrong. And because everybody has basically right now, everybody's got the same trade on. They're all bearish on the dollar. They're all short the dollar. They're all long assets, equities, commodities. And, that's not to say that trade's not right, but there are periods where everybody's on one side of the boat that, you get a counter trend move. And the dollar basically hit a low, at least in the DXY. And of course, it's 65% euro. So you've got to look into the other currencies a little further to see really what's going on. But the dollar's basically been strengthening against the yuan and a lot of other currencies since the first couple of days of the year. And that's also coincidentally when gold hit its recent lower high and started lower. But if the dollar does rally, it's bad for everything because everybody's trades are dependent on it moving lower and inflation occurring as the dollar moves lower. Whether it's the EEM trade or I think that thing hit another 52-week high today. But if the dollar does continue to rally, if you do get a bear market rally in the dollar, which I think we're more than overdue for, you've got a record short position by money managers in the dollar. You can get a squeeze at any time. And if it happens, everything's going to get torched.
So that's kind of your outlook. You think that we could get a bit of a bear market rally in the dollar. What's your kind of longer term look at what could happen with the dollar?
Well, longer term, I think there are very good reasons to be bearish on the dollar. I mean, that's always the case with these counter trend moves. You're going to have a lot of money printing. You're going to have a lot of debt. We're getting ready to pile on even more debt. You're going to have problems with, if interest rates do move up against that debt servicing problems. I'm talking about the government level. So how is the Fed going to respond to that? Well, they're going to print money. But again, you could have known that in 2008 also. It didn't necessarily, timing was still a big issue as far as taking advantage of that. And so over time, I do think the dollar will depreciate, but it's not going to be in a straight line. And that's the tricky part.
So do you think that the fact that Jay Powell didn't really mention anything about capping long-term yields could be better for gold? And how could Biden's stimulus package that he delivered be bad for gold?
Well, the fact that he didn't mention capping rates, I think, is actually negative for gold. And I think it's negative for bonds in the short run. I remember the bond market actually sold off after he gave that was, you're talking about last week. And when he didn't, I think everybody assumes that they're going to cap rates at some point. If you listen to a lot of these strategists that talk about what's going to happen over the next year, well, rates may go higher, but eventually the Fed will come in and draw the line, and this is where it's going to stop. So that assumption's already there. But you don't see the Fed talking about that yet. Again, timing. They weren't talking about unleashing billions of QE before they did it in March either. So will they come in and cap rates at some point? Yes, I think they will, but not until there's a problem and there's a reason to come in and do it. Right now, as far as they're concerned, stocks are making new all-time highs every other day. It's all good, baby. So, but the stimulus package, it should be bullish for gold, but only if the Fed monetizes it, which I think they will do. But they'll, the Fed has to allow kind of the air to come out of the balloon. There's two ways it can happen with the debt that we're getting ready to pile on. Either interest rates go up, which is deflationary, or you do it through the currency. And I think the Fed will choose to do it through the currency, is where they'll let the air out, and they'll come in, they'll buy even more bonds. They'll basically monetize the extra debt that's out there. So they create this money out of, the $2 trillion just comes out of thin air, which is inflationary. It will pressure the currency. But they're not going to do it until people are screaming for them to do it. And right now, nobody's screaming about anything.
Mm-hmm. So Lance, as you're mentioning inflation, doesn't that really need monetary velocity to pick up? And how could the Fed really try and implement, or what could they do to really try and push monetary velocity back up so that they're getting their targeted 2%?
That's a whole other issue. Obviously, everybody knows money supply has gone from the lower left to the upper right. Mm-hmm. However, velocity is dead. So you're not, the banks are not lending. So all of these billions in bonds that the Fed's buying every month in QE, it's just piling up on the bank's balance sheets. It's not going into the real economy. Now, the stimulus measures, the direct checks, are one way to inject that money into the economy. But when will the banks lend? I mean, that's a very good question. The other thing is, can the Fed create this gradual inflation that they want to create? Is that even possible? Because if I were to tell you, hey, over the next 10 years, I'm going to depreciate your currency by 5%, maybe more, let's see, what are you going to do? You're immediately going to go out and hedge it. So you almost, and yet, you can't, but I can't go, well, it might be 10, maybe 30 if I really want to get you, running to do something, because then it's like, it's Katie bar the door, everybody panics. But, I'm not even sure if it's even possible to create a gradual inflation. It may need to be more of, typical devaluation. They do it over the weekend. You go to bed Friday night, and then all of a sudden on Saturday, whoops, you just lost 50%. That's usually the way, you inflate historically. And this whole idea of, well, we can make this happen over a period of time against what are, arguably some very deflationary fundamentals, I'm not sure it's possible, but that doesn't mean they won't try.
Mm-hmm. So as you were saying about the equity markets making new all-time highs, and everything's just kind of staying up there, have they been reacting to the news and the unrest in the way that you were expecting them to?
Yeah, pretty much. They ignored it. That's pretty much what equities do. They pretty much ignore everything, go up until they don't. Mm-hmm. So no, and I mean, to be fair, I don't think the unrest that occurred at the Capitol really was a monetary or economic event. I mean, it definitely highlights, you do have a big divide between the financial markets and the underlying economy, and social unrest. I mean, we saw a lot of that last summer too. Everybody's kind of forgotten about that when people were, burned down stores and there was riots. And so it's not like this happened overnight, but it's a symptom of the, underlying economy doing very poorly. And yet the financial markets, ripping like it's 1999.
Mm-hmm. So, Lance, when you look at, let's say, different commodities like copper, do you put any weight in your analysis to them being a possible leading indicator for inflation?
I think that the fact that commodities in general have broken out to the upside is positive for inflation. But does copper signal some sort of economic boom like it used to? I'm not so sure, because there's so many more financial players now pushing on a lot of these commodities that has nothing to do with underlying demand. It's harder to know exactly, what that's telling you. But, in general, you can't deny that prices of commodities, base metals, copper, aluminum, zinc, have all moved higher since March. Mm-hmm. And that's not a negative for inflation.
Mm-hmm. So, Lance, can you tell us a bit more about your thinking around investing in an index like GDX or GDXJ rather than individual miners?
Well, I mean, the primary reason I do that is because over time, I used to only be in individual names, and I was long only for that matter, up until 2013. And the game was you tried to find small miners that would eventually be takeover targets, and that's really where you gained your alpha. But over time, because gold stocks in general all kind of move together, including silver stocks too, for that matter, because silver basically moves with gold. If you get the gold price wrong, you get everything wrong, except in a few tiny extreme circumstances. So the hardest part is to get gold right. You get that right, then you get it right no matter what equity you're in. But you never walk in one morning and your XYZ gold stock is up 50% because they found something. Maybe extremely rarely that might happen. But more often than not, you do walk in one morning and locals have overrun a mine or a mine's flooded at XYZ stock and the thing's down 50%. So and that's during a bull market in gold. So it doesn't make sense to me to have that kind of risk when the hardest part of gold investing is getting the gold stock investing is getting the gold price right. So if you use an index, you can get the leverage to the index by using leveraged products if you want to. But that's really so. But by using those ETFs, you spread your risk, and so then your only problem is trying to get gold right. And secondarily, obviously, the miners can move, more or less positively relative to gold at certain times. But your biggest risk is being wrong about gold. I don't want to have to worry about being wrong if some locals are going to come in and shoot the mine boss.
Excellent. Do you have any concluding thoughts as we wrap up here, Lance?
I think the next few weeks will be interesting. If this rally that we had that started, from Tuesday's low of 1,800 does fail, like I suspect it's going to, I think you're probably going to see, at minimum, a retest of the lows, maybe even undercut them somewhat, and it'll probably be in conjunction with commodities in general coming in at the same time, and that may be an interesting spot to start, looking on the buy side. But until the Fed comes in, I think gold's probably gonna have some rough sledding. But at some point, rates will move up enough, and the dollar will start to rally, and things will start to tumble, and then Jay Powell will come running. So that's what you want to look for.
Excellent. Are there any key levels in gold or GDX that you're looking at to kind of bounce off of? And if we break through them, it might signal more trouble?
Well, I mean, I don't think you want to see gold trade below 1,700. Anything between 1,700 and 1,750 is probably a good spot to look to be buying. I think the low back in November was 1,770. I'm not looking at a chart. I believe that's what it was. I can't remember. But with the thing I've found with gold stocks, and this is good on the upside, bad on the downside, is that no price is too low for a gold stock when they start moving lower. Technical levels, none of that stuff means anything, because unlike a Procter & Gamble or an IBM, you don't have these underlying sponsors that they don't care what price the stock's at, they just want to buy it. Whereas with gold stocks, once it starts trucking to the downside, everybody runs for the door, and there's not this embedded bid like there is for some other equities. And so really people look at the chart and they say, well, where we broke out in GDX over that prior high in February of 2020, that's support. Well, maybe, but until it holds, that doesn't mean anything. Mm-hmm. So you see too many times where levels that you think, oh, this will be support here, gold stock just blows right through that. And so you really, there again, timing is everything, because obviously, the price you pay for an investment is, the most important component of that investment.
Mm-hmm. Excellent. We can find more of your kind of tweets and thoughts at Lance J. Lewis on Twitter, and tell us a bit more about what's on the dailymarketsummary.com.
Yeah, daily market summary. It's basically it's an end of the day wrap of what happened in the markets that day, with the focus on gold and gold equities. And actually, I started doing it back when I was at David Tice. I wrote the Prudent Bears daily piece, and when I left David and set up my own shop, I basically just kind of took it with me. And it's really it's a tool. I mean, it's mostly professionals that actually subscribe to it, but it's a tool where basically I'm laying out what I'm looking at every day, what I see, and how I interpret it. And it's not a tip sheet. I'm not giving out symbols and, hey, buy this one, I think it's going here. No. It's more of a tool for people that are in the markets every day and investing and trading and trying to wade their way through the investment world.
Excellent. Thanks very much for your time today, Lance.
Yeah, enjoyed it.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.